So, good morning. It's Saturday morning, multifamily unplugged, and we are truly unplugged this morning. Here's what I want to say. If you are out there on Facebook or Clubhouse and you want to join us this morning, let me know. I'll send you a link. Uh, Carl is having trouble getting on this morning. He is remote, and I'm trying to invite a couple people on. Our guest for today decided not to show up, which is okay. But I'd love to talk to a couple people because what we were going to talk about today was we're going to talk about some language. We're going to talk about real estate, multifamily specifically, and how much there is to learn in the business. Okay, so here comes Blake. Blake, Blake, how's it going? Blake, can you hear me? Moose
Hey,
is
Mike, can you hear me?
Yeah, but Moose, you know what? You're on Clubhouse, and we're live on Facebook. We're live on Zoom. I got Dennis with me here on Zoom this morning. Our guest canceled, and Carl is remote and can't log on. Looks like Blake's got a little issue with his. Hey, Chris, log on to Zoom if you can, would you, from over there on Facebook? So if you can come and log on Zoom.
Yeah, Mike, are you on Zoom?
I'm on Zoom, I am on Facebook, and I am on Clubhouse, and you're on Clubhouse. So, uh, Carl, what happened this morning?
I don't know. I'm not in front of my desk. I thought I could do it from my phone, and I don't know if I don't have internet connection. I'm in my car right now, so unfortunately, I couldn't get back to my office in time. But yeah, I don't know. I don't. But can we still? Can you still record and everything? We can still talk, right?
Um, yeah, we can still talk. I'm actually going to send Chris Pettengale a link for Zoom. He must be remote also this morning. And so here's what I wanted to talk about today, though, is I wanted to really talk about language. I wanted to talk about multifamily language specifically, and how much there is to learn. I don't know that I really ever realized in the multifamily space, coming from just real estate into multifamily, how much there truly is to learn. Chris, I just sent you that link, by the way. So you should be able to log on now. How much there was to learn. Here's why this makes sense to me, Carl. And hey, Blake, can you hear Carl when he talks? Carl, say something.
Hey, Blake, how you doing?
For some reason, Blake can't unmute. Bottom left-hand corner, Blake, you should have a microphone on your screen there that should give you the ability to unmute. So Carl, here's why this makes sense, and I'm hoping that my microphone is sensitive enough that it's going to pick you up as we have this conversation this morning. But here's why this happened. Yesterday, I go to lunch with a friend, and this is somebody who's been in the real estate business for a number of years, and got a lot of experience. A little bit of residential, commercial, and some mortgage experience, right? And we're having lunch, and I'm talking to him about syndications, and he says to me, "What's a syndication?" And I was like taken back, right? And I thought, I said, "Are you serious?" He goes, "Yeah." He goes, "I don't understand what syndication is." And so I went through the process and explained to him. I actually did a video yesterday and posted it out on social media. But what I said was syndication is where you, as an individual, as a sponsor, you become a developer. You become the person who initiates a real estate offering, opportunity, deal, and you stay in the middle. You find that piece of real estate. You go find some other partners to come together, and to kind of help you bring it all together. You raise private equity to fund the deal. You go get the mortgage debt. Blake, it sounds like you're in now, huh?
Okay, I can hear you now too. So
Okay, good, good. Can you hear Carl when Carl talks?
yeah, I heard him when he was trying to talk to me.
Okay, good, good. All right, so the whole syndication thing, it became interesting to me that people don't really understand all the languaging, all the all the different terminology, and all of the things that people talk about in the real estate business. Have you found that, Carl?
Oh yeah, 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 Mike. I totally agree with you. I mean, we were at breakfast the other day with the group, and about half the group, knew exactly what we're talking about. The other group was just sitting there, and they were paralyzed because it'd be like if I went to Greece or to France, and if I don't know how to speak Greek or French, you're just sitting there. You have no idea what the other people at the table are saying. So yeah, I totally agree. I think it's a great topic for today.
Yeah, yeah. So, hey, Chris. Good morning. Good to see you. Hey, let me just reset the room. So we're live on Clubhouse. I got Carl out on Clubhouse this morning because we cannot get him on Zoom here for whatever reason. Technical issues here again this morning. Nothing ever is smooth, but we're live on Facebook. We've got some people out there on Facebook. Larry Parker, how are you? Good to see you. Good to hear from you, buddy. Mark Brown. Good to see you guys. Chris and Blake are on Zoom here with me this morning. We did have a guest who, at the last minute, had something come up, couldn't make it. So uh, we'll try and have him on. I told him that we were kind of booked up till the end of the year, so next year we talk about it again. But I like our regular listeners because they'll always chime in. They'll get on with us and really help participate and keep the conversation going on Saturday morning. And Saturday morning is just about education and knowledge and what can we put out there that people can learn from. So today we're going to talk about language. We're going to talk about all the things there is to learn in the multifamily space. And what I was saying earlier was that I never realized going from residential sales, where I sold residential for a lot of years, and I was in the construction business before that. I don't know. I just kind of I did a lot of work for a major syndicator in Chicago, so I kind of understood the model. I was always inquisitive, right? I always reached out to find out what they did, how did they do their business, how did they build their platform, and I understood the platform. And the platform was, hey, raise private equity from people friends and family or other people, marry it with a great real estate deal, stay in the middle. If you stay in the middle, everybody makes money. That's a syndication deal, right? It's really not anymore.
Let's talk about syndication, but let's start a little level below that. I mean, when I was a banker, I was amazed with, I mean, there were some common terms that, even if you're buying a 5 flat or 6 flat or an 8 flat, which, you're probably not going to syndicate that deal, but, let's start there and then go up to the language of there are things like, the people, I'd ask them about, deferred maintenance reserves. People didn't know what that was, or NOI, which is net operating income, right? I mean, some of those very basic terms, Mike, there are a lot of people that may not even understand what those are. So,
right.
What are some of the ones that come to mind for you? I mean, certainly because you're a big, analyst and underwriting guy. So let's talk about some of the underwriting terms that are common to you and I, but may not be to our listeners.
Yeah, right. So I think that's a great point. So one of the places I really like to start with people is, hey, do you understand the difference in occupancies? Right? You can have there's physical occupancy, but then there's economic occupancy. And a lot of times people will look at a profit and loss, or they'll look at an income sheet or the expense sheet, and they don't see the difference, right? They'll see one number. And a lot of times, and this is nothing against brokers. Brokers are in the business to sell deals, right? So they'll put in a vacancy number, right? And the vacancy number might be 10%, 5%, 8%, whatever it is in today's marketplace. But you don't have that, it's not clear, and it's there. You got to find it. It's usually called loss to lease, but it's not clear to a lot of people that that's the economic vacancy, right? That's above the line. That's before you get to your effective gross income. So here, I want you to picture this, and if you're somewhere where you can write this down for yourself, the top line is gross income. Gross income is the money that comes in from all the units if they were all rented at market rate. So if you charge $1,000 a unit and you've got a 5 unit building, you're going to get $5,000 a month, right? And let's use the number 10 because it's going to be easier for the math. Now let's say occupancy. Let's just say you have a 10% vacancy rate. So now instead of having 10 units rented, you have 9, which means your income is only 9,000 a month. And now let's say that you have an economic occupancy of 5%. And what does that mean? That means, Carl, you live in my apartment, but you're not paying rent. And so that's a loss to lease for me because you're taking up space that maybe I could put somebody else in and
Yeah.
can't.
So can I jump in real quick? Because
Yep.
let's think about that for a moment, right? It's, would you, Mike, and I know the answer to this question, but for our listeners, would you rather have a vacant unit not paying rent or a occupied unit not paying rent?
I'd rather have a vacant unit not paying rent.
100%.
100.
So just real quickly, why?
Well, the reason for that is because now I have something to rent, right? If I have somebody living in a place they're not paying rent, I got to get them out before I can rent it. And then I probably have to fix it up also. So I've already spent the cost on a vacant one to get it ready for the next tenant. And now I just have to bring them in.
Yeah. And the other thing is if they're living there and they're not paying you rent, not only can you not, that's another product that you can't sell, you can't fill, but they're also using your doors and using your water and using your, and wear and tear on the unit as well. So, from the expense standpoint, that's important too. All right. So listen, I didn't mean to take you off base there, but go ahead.
No, you're fine. So I've got gross income. I've got my occupancy that comes out, or vacancy. All right. I always try and talk in positive terms more so than negative language. So vacancy is negative, right? Occupancy is gonna show a little bit more positive number. But so I've got my gross income, my vacancy, my loss to lease, and then what I do is I add back in my other income. Okay, so people might go, other income. What's other income? So I'm a creative, out of the box thinker, Carl. You know that, and I'm always trying to think of ways to increase income. So how do we create multiple streams of income? So multiple streams of income come from laundry. They might come from a valet service. People are funny. If I can charge my tenants $7 a week to have their garbage picked up twice a week, and they put the bag outside in front of their door and have a maintenance guy or a maid service that I have in my apartment come through, pick it up, and take it to the dumpster, people will pay the $7. So how do you create other streams of income? One of the first ways I ever figured this out, Carl, you'll laugh about this, but so I have this apartment complex. I have like 20 buildings, and each building's like 20 units. And I'm looking at the building one day and I go, geez, if there's 2 doors on every building, one at one end, one at the other end, and there's 2 parking spots outside of each of those doors. So I said, I could rent those parking spots. So what we did was we took the 2 parking spots on either side of the sidewalk leading to those doors on all the buildings. So figure this out. I have 20 buildings, 40 doors, and that gave me 80 parking spots, right? 2 parking spots by every door, 80 parking spots. I started charging $25 a month, Carl. Okay. So here's what basic math says. 25 times 80, that added another $2,000 a month in revenue. Carl, Carl, let me just tell you this. I went to $50 a month, which was $4,000 a month in revenue. Okay. So let me tell you, at $50 a month, $4,000 a month in revenue, times 12 months, Carl, that's $48,000 a year I added to that. At a 10 cap, that adds $480,000 value to my building. So
yeah.
what I'm trying to do is I'm trying to figure out, and now we might have talked out of school a little bit here, right? And I'm okay with that because, we need to learn what cap rate is, and we need to learn how to use cap rate against net operating income and how we drive value in apartment complexes. All the things I didn't know before I got into it. It's just like underwriting, right? When I got into business, underwriting was foreign to me. I didn't know how to do it. I didn't have a fancy tool. Like there's a lot of fancy tools out there today. I didn't have one. I didn't have a big, robust spreadsheet like I give my coaching clients. I had to do it by hand.
Yeah.
So one of the things I try to do with people, and I have a 4-day challenge going on right now for people, is I teach them day one how to underwrite by hand. So
Yeah.
Go ahead. I know
No,
you
I was
want to
just
say
gonna say,
something.
so I want you guys to understand something. I've been in the business for 35 years. What Mike just told me, I've never thought of before, right? Number one, the garbage service. Number two, the parking at the end of the. Now, we've all been to the hotels, right? Why would someone pay $50 a month for parking close to the door? Well, if it's raining and they have groceries, they've got a parking spot that's not at the other end of the parking lot. Those are two ideas right there, you guys, that are I think they're brilliant. They're brilliant ideas. And here's the point that Mike is making with the NOI. If you can increase your net operating income by adding $4,000 a month times 12, that's $48,000 a year. At a 10 cap, you multiply that by 10, you just added $480,000 value to your building, which means, in other words, when you sell it, you can sell it for roughly $480,000, $500,000 more. Even at a 5 cap, you're talking about $250,000 just by thinking out of the box. And by the way, Mike just handed you that thing. And here's the kicker: it's called creative thinking, right? When you work with a guy like Mike, those are creative ideas that come into the equation. I would not have thought of those ideas, Mike. I think they're both brilliant. The valet thing, another thing. If you have a parking, you have somebody park their cars. You pay them what, $15 an hour, and if you have two people an hour parking the car, you're breaking even. So, again, this is what we're talking about here, guys, on Multifamily Unplugged. These ideas and understanding terminology. We're talking about other income. Other income can be vending, parking, valet, garbage pickup. All the self-storage, all the things that Mike's talking about. So that's Mike. That's brilliant. I mean, that's really great stuff.
So listen, we got kind of sidetracked here on the other income piece. So I want to go back and I want to talk about just that above the line, I call it, okay, because it's the income side. So we've got gross revenue, we've got vacancy, we've got loss to lease, which is the economic vacancy. Then we have other income that gets added back in. The bottom line now gives us EGI, effective gross income. That's the number that you want to know when you start to work through your expenses, because that EGI is the number that you have to actually pay your bills. So how do I pay my bills, right? And what do you look at when we go to bills, right? We have to look at landscaping and utilities and maybe payroll and contractor expenses and garbage pickup and maintenance. So there's a number of things that come out in expenses which drop down now to what we call NOI. And this is the statement you made earlier. NOI is net operating income. Net operating income is everything, all the expenses, including taxes and insurance, that come out before your principal and interest debt service. So now with your NOI, you want to make sure you have enough money to pay your debt service. And so does the bank, right?
Okay, so let's talk about, so it's really important, you guys. NOI is a very important thing to understand. So it's all your income, right? Your gross income, which is all your rents, less your vacancies, for lack of a better term, and then all your additional income, which is your effective gross income, right? And then we're going to talk about NOI, because this is how you figure out what the value of a piece of property is based on your NOI. So I just want everybody to really make note of how important that is.
Yeah. Hey, I think Blake and Chris might have something to chime in here on this morning. So I want to open the room up to them. Let me just reset the room. Tell everybody we're live on Clubhouse this morning. We're live on Facebook and we're live on Zoom. If you have something you want to chime in on, feel free to use the chat. Especially if you're on Facebook, use the chat. We'll get back to you. And if you are on Clubhouse, you could jump over to one of the other platforms, but maybe we could have, people could get on Clubhouse and we can hear them because we can hear you fine, Carl. I didn't, so that's interesting. So, Chris, Blake, how you guys doing this morning? Any comments or thoughts?
Doing
Yeah.
good. I like the information. Definitely taking some notes here.
Mike, I think one of the things that, I started in business incredibly 42 years ago when I was a kid. And one of the things that I had no clue about was how to read a balance sheet and income statement. And because I was fortunate enough I actually had a franchise. It was a retail auto parts franchise. They really forced me into it. And I would suggest that everyone, and I don't know what you use, Mike, as far as your accounting software, but that's really where it all starts. And to your credit, Mike, and you and I both agree, and it came about just through a conversation, that you have to start with the end in mind, because it's about quality of life and having the goals that you want to have and how to attain them. But if you start with the end in mind, then you work it backwards. And that's where the accounting piece comes in, because it's no different than running a multifamily property versus how Target does it. They look at their cost of goods and what their expenses are and what the bottom line is. And the accounting is all the same for, they're just different entries. And if you understand—
Carl, your mic is hot, so you might want to be careful in your language.
Oh, sorry about that.
Go ahead, Chris. Sorry.
So, I think it's really important for the accounting piece and getting clarity about starting from the end result. What do I want to do? How do I want to live my life? And what takes time and money to accomplish that? And if you do it correctly, you'll find that it gives you a whole lot of clarity to get to your end goals, whether that's, retiring on a beach, and going fishing or playing golf or going to all the major league ballparks with your son, So those are the things that I think they're really important in the accounting piece and how it relates to getting to where you want to go.
So let's talk about that for a minute, Chris. I think that's a really good point. So when I look at, and I think that there's different components in the real estate business and the multifamily space. Let's just focus in on that. This is multifamily unplugged, right? So if you're on the property management side, you want to use a property management software, and there's a lot of them out there. And there's some out of the box stuff, and there's platforms that are web based that you can pay so much a month and tap into. But what do they provide for you? Well, they provide a CRM for you where you can keep all your contact information for investors, for tenants, for prospects. You can market through there. You can build websites through there. You can, for your property, when you're marketing your property, you can keep track of all your property data. When we talk about property data, hey, I want to know the complex, what my unit mix is, what the floor plans are. Give me some pictures. That way I can pull all that information. I can build a flyer. I can build a website that will help me push that out to the world to try and rent a property, right? But then it has a component for bringing rent in, for paying bills, and it will give me a number of reports, balance sheets. It'll give me a P&L. It allows my tenant to pay electronically, pay their rent. It allows me to pay my bills electronically. So, get yourself a platform that's going to be able to provide all that. Here's something people might not think about. On a property management platform, get something that gives you the ability to have a tenant go online, fill out an application online, pay the fee for the credit and the background check, and it's all done for you. Now you don't have to deal with it. And then, if you have an acceptance letter or a rejection letter, you do it right from the platform. So that's how you keep that system in line. Now let's talk about the syndication business. Now my partners and I in the syndication business, we just um, adapted a platform called InvestNext. And this is an interesting platform. You know, I've been syndicating for a long time, and 10 years ago when I started, 15 years ago when I started, Chris, nobody had a platform like this. There was nothing like this. We did everything by hand. This eliminates the one employee I had in my company who her job was to bring the money in and go through all the paperwork with the investor. This platform, I get the opportunity to put my offering on it. I can do webinars through it. I can do automatic webinars through it. You, as an investor, Chris, you can go to that platform. You can read the documents. You can read the offering. You can look at the executive summary. You can see when we launch the offering, you can see what the return potential is, and you put your money right in there. Now, we never touch a check. We
What's
never.
what's the name of that?
That particular one that we're using is called Invest Next, Next. And then the other cool thing about it is, Chris, we're going to pay a X amount percent on an annual basis as a preferred return as a syndicator. And so let me just explain that. Okay. So this is about language. Let's bring some clarity to some of that language. So if you passively invest, and passively invest means that you are a equity investor, you put your money into a real estate offering. Just like now I have a real estate offering I'm doing in Tampa, Florida. It's a 40 unit. We pay an X percentage of cash flow back to you. So you get that percentage paid back to you on a quarterly basis. What happens is all my finances run through this system. And at the end of the quarter, when I go to pay my 8%, all I got to do is it's pre-programmed that, Chris, you're going to get 8% return on your investment, or 10% or 12% or whatever that return is. And here's the money that came in from the operations this quarter. Here's what you get paid. It's that simple. Then when the deal's done, and all our communications, all our reporting, everything gets to sit on that platform. And when it's all said and done, at the end, when we go to uh, exit the deal and sell off the property, now what we do is we have the calculation in there, and we say, it's a 70-30 split, or it's a 80-20 split, or whatever the investor split is. And in any of these, the investors tend to get the lion's portion. In our deals, we always make sure that the investor gets the lion's portion. We feel that it's the risk versus reward piece, and we want to make sure everybody's in a good place. But now InvestNext just figures out what you get. So it's all done for you now today. Now, from a personal standpoint, maybe you're going to use a Quicken or a QuickBooks or something for your own business operations or your personal operations. So um,
Nice. Well, I hate to do this, but I have to go because I have an investor I have to talk to.
Okay, good. Yeah, good for you, man. Go make it happen today. Thanks for being here. Thanks for chiming in. It's always
bet.
good to see you, and we'll catch up soon.
Okay. Thanks, Mike.
Thanks.
Thanks,
Hey,
Mike.
Carl,
See you,
Carl, I
Mike.
think you had something you wanted to say.
Yeah, no, again, I apologize, you guys. I might not have the best acoustics right now, but the other part about that, Mike, is when you're going to sell a property and you've got all your ducks in a row because you've been operating it like that, and you've got documentation and everything else, that just makes a better property for someone coming in to buy it, because they don't have to guess. They can actually look at your historicals. They can look at how you manage the property. They might be able to actually adopt some of your best practices, and that adds value to the property. I mean, listen, I can't tell you how many times I was a banker when somebody would walk into my office, they wanted a loan, and they had a shoebox full of receipts and stuff, and I was like, I can't do anything with this. Versus the person that came in and they had all their documents, and they had all their K1s, and they had all their expense reports, and they had all that stuff. That just makes the whole deal flow better, and it's a little thing but it's important. And here's why. If you're not a really experienced real estate person, and you're sitting in a closing or you're negotiating a deal, the other person is sizing you up. And, the more you can look professional, the better off it is for you, because you're going to get a better deal, right? They're not going to take advantage of you. And that goes right to what we're talking about today, language. If I go to France and I only know 10 French words, if I sit down at a restaurant or in a meeting with people and they all speak fluent French, they're going to look at me like, oh, this guy is, I might be twice as educated as they are in a formal education, but with regard to what we're talking about, and in this case, I'm talking about French, in our conversation, we're talking about real estate language, they're going to look at you as an amateur, right, with regard to what it is you're doing. So that's why language is so important when you're in real estate, because it's actually a measure by which people judge you, and the higher they judge you, the more respect they're going to give you, and the more respect they're going to give you, the less they're going to try to take advantage of you. And that's just the reality. So, understanding what Mike and I are talking about is very important, and having somebody that can translate for you, right? Just like if I was going to France, if I had a translator, I'd let them do the talking, or I would learn from them. That's the other real value in working with people that have experience, because they understand the language and they can communicate with the people on the other side of the table, or the banker. The banker looks at you and goes, they're going to talk that language. They're going to talk NOI, and they're going to talk EGI, they're going to talk cap rates, and they're going to talk all that stuff. And if they have to explain it to you, you just went down a few notches on their hierarchy, right? Because they go, oh, this person's not as experienced as I thought, so they're going to present a higher risk to the banker, or the real estate person that's selling the property is going to say, this person doesn't really know what what they're doing. So I'm going to try to get a better price out of them, because they don't really know what they're doing. So that's the value of what we're talking about here.
Yeah. So it's always risk versus reward, isn't it? Always risk versus reward. So interesting.
So what are some of the other terms, Mike, that are common that people might not understand?
I don't know. I was just going to ask Blake. Blake. So you're kind of new to the investing business, but you've been reading a lot. You've been studying a lot. You've been trying to get some education. You got some education over the last few years. What are you thinking is something that you need to know from a language standpoint? Have you heard a word? Have you heard a phrase that you weren't clear on and that you'd like to get some clarity on?
Well, can you hear me?
Yeah.
Okay. Well, like you said, I'm on the other side of the other side of the deal. You guys have a lot more experience, and I never became or was introduced, or my interest started a couple of years ago. And so I've been immersing myself with the education, and I constantly at work, I got the podcast going in my ear. I'm listening to audibles, I'm learning, and really a lot of these terms you mentioned, and I even write them down, the net operating income, all that stuff. I hear that a lot, and I understand what it kind of means, but really being able to sit down, underwrite a deal, and take those terms and put them to paper and really understand how it looks on paper. You can know the term NOI, net operating agreement, economic gross income, and all the vacancy, but actually being able to have a form or some way to pencil them down, and even underwrite, even if you're not doing a deal, but to underwrite deals just to get the experience doing it, that would be something that would be a good practice.
Yeah. So let's talk about underwriting, right? A lot of times I get a lot of people that say, hey, what does underwriting mean? What do you mean by underwriting? You talk about underwriting. What do you mean by that? And here's what it is. It's you take an offering from a seller, whether that comes by the way of a broker, and the broker puts together what they call an offering memorandum, always called an OM for short. And that offering memorandum, in most cases, 90% of it, 85% of it is market fluff. And the rest of it will be that last 15% will be the numbers. And what I care about is I care about the pictures and the numbers, right? Because I already know that the market is the market I want to be in. So I don't care about that, that there's a shopping center 2 blocks away, or that Adventureland is right there, or Busch Garden is right there in the case of, because I already know that submarket, that here's what I care about in the submarket. What's my household income, and how can I push rents as a result of that? So we'll come back to that, but let's talk about the underwriting. So the underwriting piece is where I take all the numbers out of the OM and I put them into my tool. Now this is where I go back and I say, hey, I didn't have that tool when I first got in the business. So what I did was I wrote everything out by longhand. And I suggest everybody do this. Write a few deals out longhand. Understand how they work. Take an OM, look at what the rent is. Now go every month. Take your calculator, right? Take a calculator and say, okay, if my rent increases 3% a year and I started $1,000 a month, well, year 2 it's X, year 3 it's X, year 5 it's X. So now I've penciled it out and I understand how it looks every year. And then I do the same thing with my vacancy. And then I do the same thing with my other income. And then I see where my effective gross income comes as a result of that. Now my expenses, I do the same thing with my expenses. And then what I look at is I say, can I operate this deal better than the seller operates it right now? So if these numbers I just penciled out are what the seller would run this deal at, can I run the deal better? Am I more experienced? Am I more knowledgeable? So here's where this comes into play. I'm buying a deal just owned by a guy that he owned the deal for 11 years and hasn't done much to it. He's kind of really just doesn't care, and his excuse always is, hey, I can't get into the units. But owners that spend a little bit of money instead of more money lose money, I think, in the long run. So here it's our opportunity, and we can go in, we can buy that, we can go in and we can put a bunch of capex construction into it and put new kitchens, bathrooms, floor coverings, paint, lighting fixtures, fix the outside up, new landscaping, curb appeal, put a new sign up, give it some lighting at night, look at it and go, holy cow, this is beautiful. And I can raise my rents. So here I could take my rents from $850 a month to $1,200 a month on a 2-bedroom because I do that. So now what have I done? I've increased value, I've increased opportunity, I've got a great return on my renovation costs. I re-engineer the property, and I turn around and I sell it, and I make my investors a nice, healthy return on their investment. So that's what underwriting does. Underwriting tells the story, and it tells it helps you put together the business plan for execution and moving forward. Carl, did I miss anything on that?
No, Mike, you hit the high points. I mean, again, it just, I can't emphasize how important this is. A lot of people think, when they're investing, they're getting started, they may have 50 grand or 70 grand, or they may, find a partner, put up some money, and they jump into a deal. And that's what I did. I did that without knowing anything about ownership and a lot of these things. And, I'm a firm believer, and I tell people all the time, take a year, take a fraction of the money you're going to put for a down payment in investment, invest in education. And it's these little things, Mike, that people don't get.
Right.
What you're talking about there is you're sitting down with somebody that's been operating a building for 12 years or however many years they've been operating. They're trying to sell it. They're trying to get top dollar. You come in, and they immediately know, because of the way you posture yourself, the way you speak, and the way that you're organized, and the way that you analyze and underwrite a property. They know immediately they're not going to take advantage of you, right? And they're going to respect you because you speak the language, right? I always use the analogy, and listen, an experienced real estate developer, Donald Trump is probably one that most think of, but John Zell or Sam Zell, John Buck, Fifield, whoever it is. if you're sitting down with someone like that, there's going to be one of the two parties that clearly is ahead of the curve, right? And so you want to be the person that's ahead of the curve. Well, how do you do that? You do that by understanding the language and having your act together, right? And having your underwriting together and having your analysis together before you sit down at the negotiation. And that's a lesson I wish I had learned, because I'm telling you, I lost probably on that first building. I think it was a 1.3 or $1.4 million deal in Chicago. I probably left 50 grand, maybe 70 grand on the table just because I didn't know what I was doing. And the sellers knew it because I didn't speak the language. So, no, I mean, you're hitting the high point.
Yeah, we do that a lot.
I'm just trying to think of what other. Let's talk a little bit about syndication. That's a little bit advanced strategy, but what's some of the terminology like LP, right? Like GP, right? Like KP. So let's talk about some of those terms that people may not know.
Sure. So when we talk about LP, that's a limited partner, right? That is really where your private equity comes from, is from that LP side. And why are you an LP or a limited partner? Because you don't have the you get a lot of the lion's share of the return, but you don't have the voting rights. You're not going to take care of the day-to-day activity. Listen, Carl, if you're going to put $100,000 into my deal, I'm not going to call you and every week and say, "Hey, we had to change these light bulbs," or "The door broke. Can I get a doorknob?" Or somebody broke a window. Can I have it replaced? I don't want to go through those motions with a lot of my investors. What I want to do is I want on a scale, to be able to put a furnace in, to put a air conditioning in without having to have to get all these approvals. That's why you're a limited partner. The limited partner puts the money in, has a limited voting right, and has a voting right. Here's where the limited partner has the voting right about finances. So do we refinance? Do we pull capital out? Do we sell? Right? That's where you're going to get voting rights as a limited partner. Now let's talk about the other side of that. The GP, that's the general partner. The general partner is the sponsor, the developer, the broker who puts the deal together and sells the deal to the LP, to the bank, to the property management people. Brings the other partners together. And on the GP side, they're the ones that build the business plan, that operate the day-to-day activities, that operate the business and cause the business to be profitable. So now here's what you get as a limited partner, though. If I'm a GP and the business goes down and doesn't operate properly, you have the right to step in and take over operations. So how we set our documents up is if there's a 3-month decrease in operations and revenue, you have the right on the LP side to step in and say, "Hey, move over, I'm taking over operations."
Yeah. So what about a KP? Explain what a KP is.
Great question. A KP is what we call a key principal. In a lot of deals today, you bring a KP in to have the net worth, to have the liquidity, to be able to go to the bank, to be able to go and get the loan, the funding, the debt, right? So, like any real estate deal, you're going to raise, private equity, 25%. That's your equity you're putting in the deal, and the debt comes from the bank, or it's going to come from one of the agencies, Fannie Mae, Freddie Mac.
Mike, you just used two more terms that people may not understand. So let's talk about net worth and let's talk about liquidity. Those are two common terms for you and I, but people may not understand what those are. So can you define net worth and liquidity for me?
Sure. So net worth is like if I compare net worth to your gross income and your effective gross income and everything that comes out in between. Net worth is how much you bring in, how much is on your asset side. So what do you own? Your real estate, your cars, your gold that you might have put away, your bonds, your stocks, your oil and gas investments, your other alternative investments. What's on your asset side of the ledger? And one thing I do with people is I teach them how to fill out a personal financial statement. You need to know what your life looks like. And I encourage people, I say, hey, look, take a personal financial statement, fill it out, carry it in your pocket. Every time you're going to go make a purchase, look at your financial statement and see if it falls on your asset side or your liability side.
Okay, so let me interrupt you again. You just used another term. We used to call in the bank the PFS, personal financial statement. We wouldn't say personal financial statement. We'd say, do you have your PFS? And a lot of people, half the people look at me like, what are you talking about? Your personal financial statement. Now, let me ask you another question, Mike. If you invest in General Electric or some common or some publicly traded stock, they have to report quarterly, right? They have to report quarterly. Why do private investors not do the same thing? You should be updating your personal financial statement on a quarterly basis if things are changing, right? If you're selling an investment, you're buying an investment, you're earning more money or earning less money, whatever it is. And people in real estate should start thinking about that as a business. And you should keep your personal financial statement at a minimum once a year, probably twice a year. And if you're active, probably quarterly. You should be updating your PFS or your personal financial statement. So anyway, I wanted to interrupt you because you keep throwing out these terms, right? Yeah. So you talked about net worth. You talked about your PFS, which is your personal financial statement. Let's talk about liquidity. What's liquidity?
Liquidity is how much cash you have or your access to cash. So let's say that you own a property. It's valued at $100,000. You have some equity in it, and that equity becomes your liquidity. So if you have 20% equity in a deal, you have, let's say that building's $100,000, 20%, you have $20,000 of liquidity. Basic math, that's kind of where it comes from. It might not be that cut and dry, but that gives you context for what liquidity is. So liquidity is really, what can I go to the bank and pull out on my ATM card right now?
Yeah. And I always like to think of it as like liquid, like it's liquid, like you can actually move it, right? It's not frozen. It's not tied up.
Right.
You could literally go out in the marketplace and trade it, sell it, or leverage it and produce and walk out with money, so that you can then, you could then go execute on a deal, or you could use that liquidity. You could use that capital for something else. Let's talk about CapEx. Explain to people what CapEx is.
CapEx is capital improvements. That is the construction work you're going to go in. You're going to take an apartment complex. You're going to take a single family house. You're going to go in. You're going to put a kitchen in, a roof on it, a bathroom in it, floor coverings, paint it. That's your CapEx improvements. That's interior.
Why do they call it CapEx?
Just a short term for,
capital expenditures.
Yeah, capital expenditures. So and then I also want to say, don't forget when you're doing CapEx and you're looking at it to put a number in for exterior, right? Are you going to paint it? Are you going to landscape it? Are you going to pressure wash the outside? Put that. A lot of times I've seen people forget, oh my gosh, I got to do something on the outside, because the curb appeal is so important, especially if you're in a neighborhood where you're trying to make something better, right? Look better. I want people to drive by and go, wow, who bought that place?
Right. So let's talk about some content. We're getting close to the top of the hour, but let's talk about, unless somebody has some questions. If they do, I can't tell, but if someone has some questions, but if not, let's just real quickly talk about some of the terminology on a contract.
Yeah, let me just add, Blake, do you have any questions at this point?
Oh, this is really good information.
Okay. All right. Yeah, and there's a couple people on Facebook, and there's nothing in the chat. So go ahead. What do you want to talk about?
Let's talk about when you're writing a contract. So what is contingency? What are the contingencies? What are, just real quickly, like how would you define the word contingencies?
Contingencies are things like physical inspections of buildings, material things in the building, the mechanicals, the structure. Other contingencies will be what banks, third-party inspections they might want. They call them phase ones, phase twos. These are environmental inspections. They're going to come out, they're going to check the ground, they're going to check around the building. Here's what I always found fascinating, right? Is the bank wants me to pay a good chunk of money for what they call a phase one, which is a topographical environmental study. And they check the ground to make sure there's no saturation or an oil contamination or any type of contaminations like that in the ground. And I always thought, well, this building's been here for 40 years, 20 years, 10 years. It wasn't there before. Why is it there today? So, I think it's just, it's a useless fee, but that's my own personal opinion.
So the thing about contingencies, if you write the contract correctly, you're going to have 5 to 7 contingencies. And as the buyer, those are your way out. Those are your back doors, right? So we used to write in partnership contingency. In other words, if I had a partner that said we don't want to do the deal, I could get out of the deal, right? We had legal review, right? That was a contingency. We had environmental review. That was a contingency. We had plans and permit contingency. We had city violation contingencies, right? We had all these contingencies in the contract where if you know what you're doing, those are your back doors so that you really are never at risk. You can get out of the deal based on these contingencies. And a lot of people don't understand those. We would always write at least 5 to 7 in, as many as we could, because they worked in our favor as the buyer, that the seller would let us get away with. Now, when we were selling a property and someone tried to pull that, we'd say, BS. No, we're not letting you do that. So that's why I wanted to bring that up, because that's a very important word that that a lot of people don't really understand that when they're writing a contract.
Right, exactly. Hey, listen, it's getting close to the end. We need to wind this thing down. Here's what I want to encourage people. If you have questions about any of this stuff, call me, call Carl, right? Reach out to us. We'll be more than happy to spend some time with you. I want to challenge you to go take my 4-day challenge. Hey, go to my website, mycoreintentions.com, and it's right there. Take the 4-day underwriting challenge. Here's what I'm going to teach you in 4 days. I'm going to teach you how to underwrite by hand day 1. Day 2, I'm going to teach you to go get an offering memorandum from a broker. Day 3, I'm going to teach you how to take the numbers from that offering memorandum, put it into a fancy spreadsheet that I didn't have 20 years ago. And then on day 4, we're going to go through the metrics. We're going to pull the levers, is what I like to call it. Pull the levers, do a stress test to make sure that the deal operates when occupancy drops, when expenses jump higher, when rents drop, when the market changes, when we're going to stress the deal to say it works or it doesn't work. So
how much, what's the cost of that, Mike?
It's $97 for a 4-day challenge. And then there's a couple free gifts with it. So,
Wow. What's the cost of you not doing that? Think about that. For anybody listening out there, think about the cost of you not investing $100, $25 a day to go through what Mike just described. I'll tell you what, if you're doing a $100,000 deal, I bet that's 10 grand. I bet that's 10 grand that you would lose. If you're doing a $250,000 deal, I bet it's 25 grand.
I think it might keep some people from doing a deal because they don't know, right? And this will give you the education to say, oh God, I could do this. I could figure this information out. I can go, So I think it cost you a deal, period. Not even the cost of the deal, but it cost you a deal, period.
And the other thing is, Mike, it's going to keep you from getting into deals that you shouldn't get into, which is some of the best deals are the deals you don't do. They're the ones you walk away from because they don't pencil out.
Right. All right. Well, listen, Carl, what are you doing today?
I am running around. I have become the chauffeur for my teenagers. I have 2 teenage daughters and a son.
Okay.
So I am between ballet, soccer, hockey, and just my daughter, who is going to be a vet. She volunteers at PAWS. On Saturdays, I am a chauffeur.
Okay. And that gives Karen, their mom, a little bit of time to have some time to herself. So that's nice.
She usually goes and gets her hair done and her paws and her claws. So it's a good thing for her too.
Okay, good. All right, great. Well, listen, as usual, it's always a pleasure, Carl. Too bad I couldn't see you this morning, but that's all right. Listen, so everybody knows, the week of October 14th, 15th, and 16th, we will not be here on that Saturday. We will be live in Schaumburg at the event in Schaumburg. So you can watch that online, or you can come to the event and network in Schaumburg. So, hopefully you will take advantage of that, because I'm going to do a 3-day deep dive. Carl, we're going to try and get Carl out there on Friday afternoon to be on stage with me and to talk about some of this language stuff and some underwriting. Yeah. And so we'll have a panel on Friday. It won't just be me, but you're going to get a ton of multifamily information. Carl will be there. He'll talk a little bit about mindset, and we'll talk deeper about language. And then my intern is going to be there, and if he's listening, he might not like this, but he's going to come up. I'm going to pick his brain and interview him about underwriting. So we're going to talk to him a lot, because he has gotten really good at this. And then I'm going to have a panel of a couple of people that I work with on the coaching side that we've helped them grow, and we're doing deals together, and it'll just be an interesting conversation, those 3 sessions. And we'll talk about IRAs. We're going to talk about how to do multifamily investing, how to get involved. And you know what? I'm going to tell my story up front, and the mistakes that I've made over the years and how to avoid those, which I think are really critical. So I hope that you're going to be there. Blake, thanks for being here with us this morning. I want to say another big shout out to Chris for being here, and anybody else that was on Facebook this morning. Good to see you. Glad you were here. Carl, have a safe day. Blake, have a great weekend. And we will look forward to seeing everybody again next Saturday here.
Yep. Thanks, guys.
Thank you, Mike.